Hello and welcome to Hilltop Wealth Advisors Economic and Market Update for the fourth quarter of 2024. I'm Ben Yeager, here today with Brittany Brinkerhoff. So Brittany, could you give us a quick recap of what has happened so far this year?
Yeah, happy to. And overall, it has been a good year for the U.S. economy and stock market. As you can see in this chart, we have seen inflation continue to come down, with September's CPI report at 2.4% growth over the past 12 months, pretty close to the Federal Reserve's target rate of 2%. The labor market has cooled since last year, but still remains generally strong with the unemployment rate at 4.1%. The U.S. Federal Reserve has now cut interest rates 2 times this year, 50 basis points in September, 25 in November, and the GDP rate for the third quarter was 2.8%. All of this is signs of a slower but still growing economy. Meanwhile, the stock market has had a record-setting year. As of early November, the S&P 500, an index tracking the 500 largest companies in the U.S., is up over 26% year-to-date, but both smaller U.S. stocks and international stocks have done well, too. In the third quarter in particular, small U.S. companies actually outperformed the large U.S. growth companies, so it's nice to see at least a temporary broadening in performance as opposed to most of the returns being driven by just a few big names. In terms of fixed income, we've seen a trend of global monetary easing, with many central banks around the world on a path of cutting interest rates. And this has allowed bond prices to generally climb over the past few months as they're pricing in those rate cut expectations. However, perhaps the biggest recent news is the outcome of the recent U.S. election. Donald Trump won the presidential election, the Republicans took the Senate, and are also likely to take the House. So, Ben, now that we have more details about the incoming administration, why don't you talk a bit about our outlook for the coming quarter?
Absolutely. And as happens just about every election, some people are elated by the result and some are quite upset. And some are just happy that it's all over with, right? All of these emotions are understandable. However, we do feel it's important to reiterate that investing and emotions really do not mix well. Many poor investment decisions are driven by fear and greed. So if you're happy with the outcome of the election, then we are happy for you. But it's not time to make dramatic changes to your investment strategy. And if you're unhappy, then we're here for you and give you our sincere condolences, but it's still also not time to make dramatic changes to your investment strategy. With that said, there are a couple policy changes that are likely coming in the next year or so that we are keeping a close eye on. The first is tax policy. We now would expect an extension to the Tax Cut and Jobs Act passed under Trump's first term, with potential for additional tax cuts on top of that. While tax cuts could help spur economic growth, there is likely to be some debate on how an extension to these cuts play into the deficit and the national debt. Secondly, tariffs. Trump has proposed some additional tariffs on China, as well as a universal tariff on all goods outside the U.S. And while these tariffs could help offset tax cuts and deficits, they also tend to be inflationary. Setting political impacts aside, and we take a broader look at the market and economy, we do expect cash rates to continue to come down as the Federal Open Market Committee cuts rates. And we are seeing economic growth at or above trend, and recession odds remain fairly low. Earnings growth has broadened recently, even beyond the tech sector, which should help provide some support for stocks as we get to the rest of the year. Of course, there are certainly risks to be aware of as well. Continued geopolitical tensions, elevated U.S. stock market valuations, and the potential for higher levels of inflation longer term are all reasons to maintain a diversified portfolio. Brittany, perhaps you could share a little bit about how we are positioning portfolios here at Hilltop.
Absolutely. And yeah, like you said, there's a lot going on, a lot that we are watching. And given these potential risks and opportunities, we do see a few areas of the market that could outperform. For example, small and medium-sized U.S. companies could be positively impacted by both lower interest rates and potential tax cuts. There's also opportunity in any sector of the market that could be made more efficient with continued improvements in AI as well. The outlook for fixed income largely depends on the timing of future interest rate cuts, and at Hilltop, we did reduce our allocation to long-term bonds because we think that having more exposure to medium-term, medium-duration bonds is a reasonable place to be, just given that we do expect more rate cuts over the next year. Overall, though, we think it's smart to continue to stay the course with a diversified portfolio that has an appropriate mix of stocks and bonds relative to your financial goals and your time horizon. So bottom line is keep investing and focus on the bigger picture as opposed to the day-to-day news.
Well, thank you all for watching, and we hope you enjoyed and learned a little something new. Feel free to share this video and our contact information with your friends, family, and coworkers. If you're not already working with Hilltop, please know that we'd love to work with you too. Simply go to www.hilltopwealthadvisors.com or scan this QR code and click on the Get Started tab. Thank you.
Thanks.